Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2025, May-June, Paper 3-2, question number 1. This is structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for the paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Nadim makes and sells toys. To satisfy unexpected sales orders, he also purchases finished goods from other manufacturers. His trial balance at 31st December 2024 is as follows. Okay, we have been given a list of information. We have some further information as well. Now, for the first part, we need to prepare the manufacturing account for the year ended 31st December 2024. Okay, so this is the manufacturing account for the year ended 31st December 2024. Okay, let us first go over all of the additional information and address it as well. Inventory at 31st December 2024, we have direct materials, work in progress, finished goods. So finished goods is 10% of the goods manufactured at transfer price during the year. So we will only be able to calculate the finished goods once we have prepared our manufacturing account. Then there was no inventory of purchased finished goods. All right. Carriage inwards of 8,500 should be apportioned 90% to the purchases of direct materials. So this will be 8,500 times 90%, which results in 7,650, and 10% to the purchases of finished goods. So that will be 8,500 times 10%, which results in 850. Then light and heat of 9,200 included in the office expenses should be apportioned 75% to the factory and 25% to the office. So this 9,200 was previously included in the office expenses. Let's remove that first. So we need to remove the 9,200 here. Then 75% should be apportioned to the factory. So 9,200 times 75%. This results in the value of 6,900. Then remaining 25% should go towards the office. So 9,200 times 25%, which results in 2,300. So this 2,300 should correctly be included within our office expenses. So plus 2,300, and whatever amount we apportion towards the factory, this 6,900 will now be part of the factory overheads. So we can include that as well. Let's write it down, the factory overheads. Okay, so we can just write it down here. Instead of listing down different headings for factory overheads, let us just calculate the total and write it down. So 6,900 for the factory light and heat. Then we have our factory indirect expenses, which is also part of the factory overhead, so 33,350. Then we have factory supervisor's salary, which is also indirect expenses, so that should also be included as part of our factory overheads, the 19,000. Then non-current assets are depreciated at 15% per annum using the reducing balance method. Okay, so we have works machinery at cost and office equipment. So any depreciation on office equipment will go towards administrative expenses. Any depreciation on works machinery will go towards factory overheads. So let's figure out the depreciation for works machinery first. It is a reducing balance method, so cost minus accumulated depreciation, and we do not have any information regarding purchases during the year or disposal during the year. Now times the rate. The rate given in this case was 15%. So the depreciation on works machinery will result in the value of 15,300. Then we repeat the same process for office equipment as well. So the cost is 74,000. Accumulated depreciation is 32,000 times 15%. This results in the value of 6,300. Then, in this case, we're not talking about a limited company. We're talking about a sole trader. So we do not need to include administrative expenses within our statement of profit or loss. We can just list down the individual heading as our depreciation on office equipment. The rate of factory profit is to be increased by 5% for the year 2024. So we need to figure out the rate for previous year. In this case, okay, we have the finished goods. This is all manufactured, 48,000. And since no indication is provided, this is our transfer price. Then we have the provision for unrealized profit as well, which is 9,600. Now the cost for our finished goods at the opening date will just be the transfer price of 48,000 minus the provision for unrealized profit of 9,600. This will result in the value of 38,400. Now we need to calculate the rate. Basically, while figuring out the profit, it will just be cost times rate. This will be equal to profit. We know the cost in this case to be 38,400. We're trying to figure out the rate, and the profit is given right here to be 9,600. So the rate in this case will just be 9,600 divided by 38,400, which results in 0.25. So our rate is 25%. Now for the current year, we need to increase it by 5%. So the new rate will be 30%. Okay, now we can start preparing the manufacturing account. The very first item we include is the opening direct materials inventory. Let's take a look above. The opening direct material is given right here, 16,600. Then we need to include the purchases of direct materials. Let's take a look above. The purchases of direct materials is given right here, 104,000. Now we need to check for any purchases returns as well. Okay, we do not have any sort of purchases returns, but we do have the carriage inwards, where out of 8,500, 90% belong to the purchases of direct materials. So 7,650 will go in our manufacturing account, because this is the carriage inwards on direct materials. Now we can include our closing direct materials inventory. That was also given above. Right here, the closing direct materials was of 17,200. Now we will figure out our cost of direct materials consumed. 16,600 plus 104,000 plus 7,650 minus 17,200. It results in the value of 111,050. Then we need to include all of our direct labor as well as direct expenses as well. In this case, we have factory wages, which is the direct labor, 156,200. That's our factory wages. All right, then I don't think we have any other any other direct expenses. So that should be all. And now we need to add up our direct expenses and label it as our prime cost. So that's 111,050 plus 156,200, which results in 267,250. Now we will include factory overheads, the total factory overheads. You can choose to list down the individual values as well, but I find it easier to do it this way. Okay, we have 6,900, 33,350, 19,000, and we also calculated the depreciation on works machinery, which is to be included as part of our factory overheads. That's 15,300. This results in our total factory overheads to have the value of 74,550. Let's write it down. Then we need to add up the prime cost and factory overheads. So 267,250 plus 74,550, which results in 341,800. And you do not have to label it anything. After the total of your prime cost and factory overheads, you need to make adjustment for your work in progress. So the opening work in progress inventory should always be added. And the closing work in progress inventory should always be subtracted. Okay. So our opening work in progress is of 28,400 and the closing work in progress is of 20,200. So we need to add 28,400 and subtract 20,200. Then this will give us our cost of production. That will be 341,800 plus 28,400 minus 20,200, which results in 350,000. Then we need to add our factory profit, after which we will get the transfer price. Okay, so the rate of factory profit for this year, we calculated it to be 30%. So that will be 350,000 times 30%, which results in the value of 105,000. Now the transfer price will be sum of the cost of production and factory profit, 350,000 plus 105,000, which results in 455,000. That is all for the first part of this question. Let's move towards the second one. We now need to prepare the statement of profit or loss. So statement of profit or loss. This is for the year ended 31st December 2024. Okay, for the statement of profit or loss, we always start with our revenue. Let's take a look above. The sales revenue is given right here. That is 724,000. Then we need to include our cost of sales. This is a combination of manufacturing account as well as a trading business. In this case, we are producing our own goods as well as purchasing some finished goods as well. So the cost of sales will include our opening finished goods inventory, then we also have some purchases of finished goods, and for those goods that are manufactured by our own factory, we need to include the transfer price, which we calculated from the manufacturing account. Then there might be some carriage inwards. Yeah, actually 90% belong to our purchase of direct materials and 10% belong to the purchase of finished goods. So we have the carriage inwards as well. Then we have our closing finished goods inventory. Okay, let's start with the opening finished goods inventory. Right here, the opening finished goods, this was all manufactured. The value is 48,000. And always remember that within the cost of sales for your manufacturing business, you always include your opening and closing inventory at the transfer price. So we need to include the 48,000. Then we were given the purchases of finished goods as well. Right here, the value is of 28,000. Alright, then for the carriage inwards, we have 850 here. So we need to include this for the purchases of finished goods. So we have 850. For transfer price, we've already calculated the value to be 455,000. Now for our closing finished goods inventory, this is supposed to be 10% of the goods manufactured at transfer price during the year. So this is just 10% of this value. So 455,000 times 10%. This will result in the value of 45,500. Let's write it down. Now, the total of our cost of sales will be 48,000 plus 28,000 plus 455,000 plus 850 minus 45,500, which results in 486,350. We need to subtract this from our revenue so that we can calculate our gross profit. So that will be 724,000 minus 486,350, which results in 237,650. Right after the gross profit, we need to add back our factory profit, which we've already calculated before, right here. That's 105,000. Then we need to make adjustment of unrealized profit. This is the unrealized profit attached to our inventory. Now, we already have the unrealized profit for our opening inventory. That was 9,600. So, for opening inventory, the unrealized profit is 9,600. And for the closing inventory, we can see right here, 45,500 is our transfer price. Transfer price includes the cost as well as the profit. And the rate of profit in this case was 30%. So, 100% is the cost and 30% is our profit. So it means that 130% of a value will be the transfer price, 45,500. As of now, we only need to figure out our unrealized profit, which is the 30% value. So we just utilize the unitary method, 45,500 divided by 130% times 30%. This results in the value of 10,500. Now, we can clearly see that compared to the unrealized profit for opening inventory, the unrealized profit for closing inventory has increased. And any increase in the unrealized profit should be treated as part of the expense. So, the increase is of 10,500 minus 9,600, which results in 900. So, we need to treat this as expense under our adjustment. So, we'll be subtracting the 900. Now, the total for factory profit and the adjustment of unrealized profit is 105,000 minus 900, which results in 104,100. Now, we need to add this value to our gross profit to get our effective gross profit. That will be 237,650 plus 104,100, which results in 341,750. Okay, after this, we just need to list down all of our expenses. In this case, we do not have to categorize it under the heading of administrative expenses and distribution cost because we're not talking about a limited company. We're talking about a sole trader. Okay, I think we've already made adjustment to the office expenses. So that will be 174,800 minus 9,200 plus 2,300, which results in the value of 167,900. Let's write it down. So we have our office expenses, 167,900. Then we've also calculated the depreciation on office equipment. That had the value of 6,300. Let's write it down. Then let's go over all of our information and see what we've missed. We've included the office expenses. Okay, there's carriage outputs. This will also be treated as part of the expenses. We need to show the value of 9,440. So that is our carriage outwards, 9,440. Then we've included the carriage inwards as well. Okay. Then all of these are assets and liabilities which will not be shown within our statement of profit or loss. So that should be all. Let's calculate the total expenses. 167,900 plus 6,300 plus 9,440, which results in the value of 183,640. Then we can calculate our profit for the year. That will be 341,750 minus 183,640, which results in the value of 158,110. That is all for the second part of this question. Let's move towards the next one. We now need to explain why unrealized profit occurs in some manufacturing businesses. So the value of whatever goods that are manufactured are included within our statement of profit or loss at the transfer price, which includes the cost as well as the factory profit. And closing inventory means those goods which are yet to be sold by the end of the year. And profit will only be realized once the inventory are sold. But in this case, the closing inventory also includes the factory profit element, which has not yet been realized. Let's write it down. The value of goods manufactured is transferred to the statement of profit or loss at transfer price, which includes cost as well as factory profit. Now, value of goods unsold, which is basically referring to the closing inventory at the year end, includes factory profit, which has not yet been realized. Alright, that is all for this part. Let's move towards the next one. We need to explain why the provision for unrealized profit is accounted for in the statement of financial position. So we can just explain three of the accounting concepts. The very first one is IS2. So according to International Accounting Standards 2, inventory should be stated at lower of cost and net realizable value. The second accounting concept is the prudence concept. So according to prudence concept, the value of inventory or the value of asset should not be overstated. Then for the last one, we can just explain how the provision for unrealized profit is accounted for in the statement of financial position. Since the inventory of finished goods should be included at cost, the unrealized profit should be removed from the transfer price. Alright, that is all for the third part. Let's move towards the next one. We have some additional information. Nadim plans to incorporate his business. His only concern is that the financial statements mean then have to be audited. We need to advise Nadim whether or not he should incorporate his business in view of his only concern. Justify your answer. So if the financial statements are audited, then the financial statements are more credible. All of the financial statements show a true and fair view. Let's write it down. Audited financial statements are more credible as it shows a true and fair view of the business. Let us also look at the marking. This is of 5 marks. So we need to have 2 points for why it should be audited, 2 for why it should not be audited. The second reason is the auditor might catch all of the fraud and errors more easily. Let's write it down. Auditor might be able to detect frauds and errors easily. Now we need some comments regarding why it should not be audited. The very first thing is that audit fee is costly. So audit fee is costly. Then the second thing is that we will have to employ a professional accountant in order to have all of our financial statements audited. Let's write it down. Need to employ a professional to have the financial statements audited. All right, now based on these factors, we need to make a final decision. So I would suggest that auditing is not really important because Nadim's business is still small. Let's write it down. Nadim should not incorporate his business in view of his only concern as Nadim's business is still small and does not need auditing. Alright, that is all for the fourth part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.